from Lagarde and from Powell. At the margin, they seem to be giving slightly different signals in terms of the likelihood of rate cuts or the scale of rate cuts to come next from each of those big central banks. But any other big messaging?
They're definitely giving very different messages. I'm not sure if it's particularly new. I'd say, if anything, in fact, Lagarde is probably the slightly more new one, where she has definitely turned a little bit more dovish over the last weeks or months. But I think the interpretation of Powell yesterday of being hawkish because he said it will take time to return to neutral is probably a little bit overdone. It's related to the fact that we've just priced in such an aggressive amount of rate cuts that will only be justified if there is some kind of severe crisis on the horizon. That for any kind of news flow, the starting point is we're asymmetrically skewed for rates to go higher. It does not mean that yields can't go a little bit lower if we get very bad news. For example, a very negative jobs report this week. Of course, yields might return to the recent lows, but they can't go much lower because we're already pricing in crisis time in the rates curve, which means the natural trend without news or with neutral news is for yields to keep drifting higher again.
Mark, you're pro stocks, you're quite bullish. The question is, how much volatility do you think that comes with right now?
Rather than the volatility question, it's about rotation, I think. And one of the things I want to emphasize, like, as you know, I've been very bullish stocks all year. I don't think the value is in the US stocks. I'm not bearish US stocks. This is not about a negativity about US stocks. But our colleague Cameron Christ wrote this excellent piece yesterday about a lot of the reason US stocks have done so well for the last 15, 16 years. The US exceptionalism was there was no alternative. Well, you know what? If you start believing in the China story, there's a bit of a turnaround. There might be an alternative, not just in China stocks, not just in Hong Kong stocks, but all the derivative trades. EM stocks around the world are still very discounted, very under-owned. So we might be at the early stages, which we've probably seen in the last couple of months, not just with the China stimulus last week, which gave it a kind of nitro boost. We might be at the early stages of rotation a little bit away from US stocks to the rest of the world that is massively discounted on a relative basis. Again, this is not about being bearish US. It's about, if you're bullish, there's other places to look outside the US.
Does that dynamic turn if we get a Trump presidency, a Trump 2.0, that U.S. exceptionalism that you point out, does that continue as a more defensive trade?
It's a great question, Critty. I don't know. I'm struggling to work out what that'll mean. I think at the moment, markets, it's such a close election, and we're so unclear about exactly what policies will be enacted. It also depends whether which way the House goes as well, that I think that that's not yet affecting markets, and I'm kind of delaying the analysis there. There's a risk, as you say, it kind of doesn't persist or it goes into a more defensive iteration. But until the election, I think it remains bullish for global stocks outside the US. US is the volatile sector. It'll probably go nowhere overall.